Are you a young adult ready to start a Roth IRA? Or a parent looking to open a Roth IRA for your 12-year-old and wondering how you should invest? Well, stick around because today we're looking at options and most importantly, helping you avoid some common mistakes that many find themselves having to correct later in life. So let's get it right from the start as we look at some investment tips for your brand new Roth IRA. Hey everyone, this is AJ, your ace in the hole, and welcome to the channel where we simplify personal finance and provide tips for young adults and others just starting out. Now, let's jump right in. In today's video, I'm going to discuss how to start investing in your new Roth IRA. We'll look at methods that take advantage of the benefits of a Roth so you understand the best approach as a young investor or as a parent kickstarting their child's savings. Now, if you're not already familiar with the Roth IRA, you should first pause this video and check out my Roth IRA overview video here for a detailed look. Then circle back to this video, which is more focused on how to approach investing within your Roth IRA from the beginning. Go ahead, I'll wait. Oh, you ready? Let's go. Since you're here, you may be somewhat aware of the benefits of a Roth IRA and why it's considered one of the best savings and investment tools available. A Roth IRA allows you to save money each year up to an annual contribution limit based on your earned income for that year. You then invest that money into a variety of investment options and earnings grow tax-free until you reach the retirement age of 59 and a half, in which you can then withdraw your money, also tax-free. Young adults age 18 or older can open an individual Roth IRA, while a custodial Roth IRA can be opened by a parent on behalf of their children under the age of 18, as long as they're earning some sort of income. Now, you may or may not already be familiar with investing in general, and investment options for a Roth IRA can vary depending on where you open your account. But if you use any of the popular investment firms such as Fidelity, Vanguard, or Charles Schwab, you'll have access to a broad array of investment options, such as individual company stocks, mutual funds, ETFs or exchange-traded funds, as well as less risky options such as bonds and CDs. Now, before we get into the details, I have to say that none of this should be considered financial advice. This content is based on personal experiences, observations, and a variety of materials, so be sure to do your own research and seek financial advice as everyone's financial situation is different. Research also shows that roughly 30% of YouTube viewers forget to subscribe to the channels they watch, so if you would, take a quick second to subscribe. It's totally free and it'll ensure you get a peek at our weekly topics. Now, back to Roth investing. The first step in maximizing your Roth IRA is just that, investing your contributions as opposed to just leaving your money in cash making little to no earnings. This is the most common mistake among Roth account holders. A study by the Vanguard Group found that over half or 55% of investors who make IRA contributions still had their assets in cash even after 12 months. The study also revealed that contributions that are still in cash after 1 year remain that way for at least 7 years, with younger investors, particularly age 20 to 29, the least likely to invest, which is even more unfortunate since they stand to benefit the most from longer-term compounding growth. To kick this off, there are two important terms to understand. Asset allocation, or what you invest in, refers to the mixture of asset types within your investment portfolio, for example, stocks, bonds, or cash. And asset location, or where you invest, referring to which types of accounts hold your investments. For example, a taxable account, such as a brokerage or savings account, a tax-deferred account, such as a 401k, or a tax-free account, such as a Roth IRA. These both play a role in our discussion. First up is to get your account funded. This can be done easily through online banking transfers, which can even be automated as most banks offer automatic fund transfers between, say, a checking or savings account and a secondary account, in this case, your Roth IRA. For example, the 2025 Roth IRA contribution limit for those under age 50 is $7,000 or up to your earned income for the year if it's less. So one option might be to divide $7,000 by 52 weeks and automate a weekly transfer of $134 into your Roth IRA. This is a hands-off approach and spreads out deposits over time in the event you can't afford a lump sum contribution. Which brings me to tip number 1, always contribute annually to the Roth limit to maximize the Roth benefit, assuming you earn enough income to do so. And if you can't afford that much, at least contribute something. Now, once you fund your Roth IRA, it's time to start investing. Investment selections for those just starting out should center around a longer time horizon and tax efficiency so that you're not scrambling to avoid taxes later in life, which can diminish your investments unnecessarily. And remember, all earnings in a Roth are tax-free, meaning you don't pay any capital gains or ordinary income taxes as you do with other types of investment accounts. There are numerous types of investments you might choose, but let's start out with a simple approach. By this, I mean purchasing a lower risk growth investment that requires little maintenance. Basically, set it and forget it. This is actually the best proven method. Why, you might ask? Well, did you know that the best investors are dead investors? Well, sort of. In 2014, Fidelity Investments conducted a study of the best performing investment accounts and found that the accounts with the highest returns belonged to dead investors, or those who had forgotten about their accounts. The moral of this story is that you don't need to do a lot. Just choose investments with a solid track record and let them sit. Some of the best options for this investment strategy are index funds or ETFs. These are funds made up of a grouping of individual company stocks, greatly reducing investment risk since exposure is not completely dependent on a single company's performance. Some popular options are the Vanguard S&P 500 ETF, or ticker symbol VOO, which invests in the top 500 U.S. companies, or the Fidelity Total Stock Market Fund ETF, or ticker symbol VTI, which invests across the entire U.S. stock market. Some quick history: if you were invested in the S&P 500 for any 20-year period over the past 20 years, you never lost money. Check out my video here on savings versus investing for more on this. These can be extremely productive and safe options based on historical performance over these time frames, especially when investing early. Now, if you want to add a little spice to your investments, meaning a slightly higher risk and volatility but with greater growth potential, you might add some small or mid-cap ETFs, which are funds that invest across small to medium-sized companies. Then there are more niche investment options, such as REITs or real estate investment trusts. These allow you to invest in real estate-related assets without actually having to buy physical property. Or ETFs that focus on certain business sectors, such as technology or energy. Of course, you can always add single company stocks to add even greater growth potential, but be cautious, as this will add quite a bit of risk to your portfolio. Finally, there are much safer investments, such as bonds or CDs, which do come with much lower returns and are better suited for investing outside of Roth, which is typically aimed at longer-term high growth. However, one advantage to choosing these in a Roth is that you pay no taxes on the interest earnings, which you will pay if investing outside of your Roth. Which leads me to my next topic: dividend stocks. Dividend stocks are shares of companies that pay out a portion of their profits in cash to shareholders on a regular basis, usually quarterly. These payments are called dividends, and they can provide steady income in addition to normal stock growth. Dividend stocks are normally mature companies, such as Coca-Cola or McDonald's, that have consistent earnings and are beyond their early growth years, preferring to reward shareholders with cash payments versus companies that are newer or fast-growing, such as Tesla, Meta, or Netflix, that choose to instead reinvest profits into innovation or expansion. There are also dividend ETFs comprised of groups of dividend stocks, which again are lower risk. A couple of the most popular dividend ETFs are the Charles Schwab U.S. Dividend Equity ETF, or ticker SCHD, and the Vanguard High Dividend Yield Index Fund ETF, or ticker VYM, among others. Now, how does this all relate to your Roth IRA? A Roth IRA is a great place to hold your dividend investments, avoiding taxes on dividend payouts you would otherwise have to pay if held in other taxable accounts. A popular investing mistake is holding dividend investments outside of a Roth, which can create a significant ongoing tax bill. The tip here: place all dividend investments within your Roth IRA and all non-dividend investments outside of your Roth, and you will never pay taxes on dividends, while simultaneously reducing taxes on investments held outside of your Roth. You can also choose to reinvest dividends, which instead of accepting a cash payout, you elect to use dividend funds to purchase additional shares of the investment, which is a great way to automate investing, compounding growth even further. Now, whether you take the cash dividend or you choose to reinvest, you're still required to pay taxes on dividends each year. Again, unless these investments are held within your Roth IRA. Now, if all of this is getting a little confusing, there is an even simpler approach, which is investing in popular target date funds. Offered by most major investment firms, you simply decide on your optimal target retirement year and invest in the fund for that year. For example, if your target retirement year is 2050, you would simply invest in the 2050 fund. These funds automatically adjust their asset allocation over time as your retirement year approaches, starting off aggressive for maximum growth and then reducing risk as you get closer. These are great options for hands-off investors, although they can come with slightly higher fees. Speaking of fees, another consideration is choosing investments with low fees indicated by their expense ratio. Most ETF and mutual funds charge a slight fee for fund management, although ETFs typically carry the lowest, usually less than 0.1%, with some carrying zero fees. Mutual funds tend to be higher due to more active management and can be as high as 0.8% or more. This might not seem like a lot, but if your holdings grow substantially over long periods of time, this could add up. So while this presents some starter options for your Roth, it's really about asset location and the type of investments you place within your Roth. Investments that generate high growth or taxable earnings are perfect options for a Roth, since you can avoid taxes altogether. Instead, placing non-income generating and lower growth investments outside of your Roth, reducing taxes. Hopefully this provided some guidance on how you might choose to set up your Roth from the start, so that you avoid the mistakes many make, scrambling later in life to avoid mounting tax bills that could have been avoided through appropriate planning. Now, there are hundreds of investment options to choose from when investing, and I have many future videos planned that take a deeper look into many of these. So be sure to subscribe to the channel so you don't miss those. And be sure to share this video with anyone that might benefit as well. And I hope to see you back here for the next one. This is AJ, your ace in the hole. See ya.